This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of the previous session together, I left you there to review through the answer to example 4, which you'll see on the screen here, and hopefully again you've worked successfully through that. But let's just point out a few things that were critical in terms of how we derive those assessments. What we see, of course, is we follow the normal bases of assessment for opening years. So having identified the start date, that was the 1st of August 16, that gave us the first tax year 16-17. That is always an actual basis, and we established the amount of profit or loss that fell into that basis period. Here, of course, it was a loss, and that loss was then available for relief. What we haven't yet discussed, and that's where we move on to in terms of this particular lecture together, is to discuss what are the possible uses of that. Now, some of these you should already know. You're already aware of the reliefs that you can take against total income of the current tax year, and or the preceding tax year, and you're also aware of the carry forward. What we'll see very shortly is that there's a specialist opening years relief that we spoke of at the beginning of our Chapter 7 studies, and that will come to very soon. But in that first tax year, there was just a loss. It was 16,000. That is the amount of loss available in relation to the tax year of loss 16-17. We moved through to the second tax year. Did we have an accounting period ended in that second year? Yes, we did. How long was that period? It was a short period, i.e. less than 12, here to be precise, 10 months. Therefore, as ever, we look at the period of the first 12 months of trading. What did that bring in? All of the opening 10-month loss, but there is no concept of overlap loss. Therefore, we had to remove the amount that had been used in 16-17, and that left us with £4,000 worth of loss. But that was only 10 months out of the first 12, so we had to put that together with 2 months worth of the second accounting period, which was a period of profit. That profit of 8,000 wiped out the loss and left you with a profit assessment of £4,000. Moved on then to 18-19, our third tax year, and as is usually the case, by then we could use a current year basis, which of course was the 48,000 for the year ended May 18. Now, what we didn't discuss last time, but hopefully you've read about here, is that as we have a profit of 8,000, the 2/12 of 48,000, that has been included in the computing the assessment for 17-18, here we have that £8,000 going in and deriving the net £4,000 assessment in 17-18. And it's also, of course, a part of the £48,000 assessed in its own right in 18-19. We've got an overlap profit. Now, there are no overlap losses, but there is overlap profit, of course. So that overlap profit of £8,000, as is here, the figure used in both 17-18 and 18-19, that therefore, as ever with overlap profits, would serve to reduce the assessment in the final tax year of assessment there. So, we were able to establish, using our normal bases of assessment that apply in opening years, what the assessments, what the loss reliefs were in relation to each of those opening tax years. Here, from 16-17 through to 18-19. There was only one loss figure that arose in relation to a tax years of assessment, and that was 16-17. So what possible uses would there be of that? Now, what you should know is, as I expressed a few minutes back, your normal loss reliefs. It doesn't change. What you can do with that 16,000, you could carry forward against future trading profits. Now, that carry forward, of course, would firstly go against the £8,000, I beg your pardon, let's get rid of some of those squirrely bits there. That £4,000 assessed in 17-18, and then against the £48,000. A more immediate use, of course, would be to set off against total income. Total income of, it is already ringed there, the current tax year and or the preceding tax year. That would take you back to 15-16. It doesn't matter that in 15-16 you hadn't actually traded. We only started to trade in 16-17. We can, using this provision, our normal provision, set off against the total income of the current tax year 16-17 and or the preceding tax year 15-16. But in addition to those loss reliefs, there's also a specialist, as we keep calling it, opening years loss relief. And that is what we can discover back in our notes here, section 5.1 of chapter 7, our opening years loss relief. And what we're going to see, it's very similar to what we've just been talking about, being a set off against total income. But your normal provision that is available only allows you to go back 1 year. If we have a new business, starts to trade, and in those opening years sustains a loss or losses, the idea here is to give that business, the individual, a better chance of continuing in that business. There's a more immediate tax relief that is available. Now, the only way we can improve on a 1 year carry back is by allowing the taxpayer to carry the loss back for more tax years. And that's exactly what we'll discover is going on here. So, the relief to begin with is available for losses incurred in any of the first 4 tax years of trading. So that's why it's specialist, only available in the first 4 tax years in which we have traded. Clearly, in the previous example, there was a tax year in the very first tax year, 16-17. That is the amount, therefore, that would have been available for this specialist relief. What can we do with it? Well, as we've already said, again, the relief is against total income, something we're very familiar with. But instead of only being able to go back 1 year, we can now go back against the 3 tax years preceding the tax year of loss. We get a 3-year carry back, giving us, of course, a far better opportunity to get use of that loss in relation to those earlier years. In relation to those earlier years, we will already have paid our tax, so any reduction in our taxable income creates a reduction in the tax liability, a tax figure we've already paid, and therefore we would now be generating repayments. We can see the logic here of HMRC. They're going to give you the tax relief for your business at some point, if not now, then in the future. Well, here, by extending that loss relief available in these opening years, maybe that gives the business, which after all is a loss-making business to begin with, a better chance of survival. And it's a good investment then, isn't it, for HMRC, that if that business survives rather than falls, if it survives, it goes on to become profitable, it registers for VAT, there are VAT revenues, there are tax revenues in relation to the profits made, the business employs people, yet more income tax and national insurance contributions indeed to be collected. That's not a bad investment so far as HMRC is concerned. Well, whatever their reasons for doing it, this is the relief that is available now. So, for a loss sustained in any of the first 4 tax years of trading, we've seen, using the bases of assessment applicable in opening years, how to compute any such loss that arises in any of those first 4 tax years. Then, rather than just the simple claims against total income of current and or preceding tax year, we get the ability to go back against the 3 preceding tax years. Now, this is a single claim that goes against all 3 years. Again, as we've already said, no need for the trade to have been carried on in those previous tax years. If, as in the previous example, we make a loss in the opening tax year, I think it was 16-17 in that previous example 4, then we would be able to go back 3 years from 16-17. So that would be 15-16, 14-15, 13-14. And as we'll see in the subsequent notes, the loss that is applied on a first in, first out basis. So it goes against all of those preceding 3 tax years, not just one of them, all of the 3 preceding tax years, and we attack those on a first in, first out basis, i.e. we go back to the earliest year first. So in that example 4, the loss of £16,000 that arose in the 16-17 tax year, we could take that back and set off against the total income of, firstly, 13-14, 3 years ago. No partial claims again, like we saw with our normal current and 1 year carryback. No partial claims. Go against total income. If the loss is bigger than the total income, then any remaining loss will now move forward to 2 years ago. And likewise, go against total income. If we've got enough loss to eliminate all of that total income, we move forward to 1 year ago. So the loss is set off against the total income of the preceding 3 tax years of assessment, starting with the earliest year first. Relief operates, as we've said, against all 3 preceding tax years on a FIFO basis. As with current and preceding year relief, partial claims are not available. So again, any relief that attacks total income runs the risk of wasting our personal allowance. The loss, as we know, available as relief is computed the same way as for profits, as we got the £16,000 loss in the previous example. So in our early years of trading, we have got this specialist opening year's relief with the extended carryback. We've got our normal loss relief against total income of the current and or the preceding tax year. If we make a claim under either of those years, then for that year, you've got the possible extended claim against capital gains as well. And again, that's a possibility maybe that if you are to set up your own business, you need cash, you need to raise capital. One way you could do that is by selling off an asset or assets upon which gains arise. Also, there may be gains, therefore, the claim against total income, opening up the claim against capital gains, may be a realistic one in terms of what might be applicable in a practical business scenario here. After that, if we have not used all the losses, though I think there's enough availability there to use all those losses, but otherwise, as we know, it's a carry forward against future trading profit. Okay, that said, we have now example 5. Now then, I want you here to start this. I'm going to set you little tasks to do one at a time. We've got to calculate the taxable income for all years after claiming opening year's loss relief. So this particular question is very specific. We're going to be looking at opening year's relief. And again, throughout, we'll assume that our personal allowance of £11,500, as it is for 17-18 tax year, will apply throughout. So what have we got? New business, starting to trade. As ever with a startup, whether it's profits or losses, you want your start date. Your start date determines your first tax year. So 1st of July 16, so 16-17 is our first tax year. We've got the adjusted profits and losses here for tax purposes for the first 2 accounting periods. Now, what is very good news as regards sorting bases of assessment out in opening years is that the opening accounting period is itself a year end. What does that mean? It means CYB will become immediately available from the second tax year onwards. We know that the first tax year is 16-17, and we know that the basis of assessment will be actual. We then know that we have a year ended 30th of June 17, which using CYB, what tax year does the 30th of June 17 end in? It ends in the 17-18 tax year. So 16-17 straight into 17-18 CYB. So the bases of assessment are made much easier by the fact that the opening accounting period is itself 12 months. And again, something that has been used regularly by the ACCA in terms of exam questions. We see that we've got a loss to begin with, and that means that we'll identify the loss that arises in relation to the first tax year, where a part of it will be available, the part from the start date, that being the 1st of July 16, through to the following 5th of April. Because then in 17-18 we use CYB, all of that 12,000 would come into play again, but of course we can't have the loss twice over, so we would reduce it by any loss used within the 16-17 tax year. That will then allow us to move on to the year ended 30th of June 18, where again, of course, we're on CYB, and that will give an 18-19 tax year assessment of a mere profit of £2,500. Now, he said that Fiona had previously here been employed. She's decided to go from employment to self-employment, hopefully with higher profits and better performance to follow on here. But the remuneration from the employment, which ceased on the 30th of September 15 for recent years was. Now, that obviously is within the 15-16 tax year. So you've got assessments here in 15-16, 14-15, 13-14. The owner also has other income, property income of £4,500 per annum. So again, that will allow you to work out the total income in those years. Now you look at how many tax years have been given to you here. There's a lot. We go back as far as 13-14, and we can come through to as far as 18-19 in terms of the information provided. Our very first tax year of trading in which a loss, as we can clearly see, is sustained, is 16-17. And with your opening year's loss relief, remember, set off against the total income of the preceding 3 tax years on a first-in, first-out basis. So 16-17, like it was in example 4, go back 3 years, 15-16, 14-15, 13-14. We go back to 13-14 there. In terms of 13-14, here is information about income of that year. Don't forget the property income as well. But your first task is to establish the amounts of loss and any assessments that arise using the information you have for those 2 accounting periods. So get yourself into assessment mode, bases of assessment, opening years, and work out either what is, as it will be in the first 2 tax years, how much loss is available for relief in relation to each of those years, and then, having got that, move on to work out the profits assessable. That, of course, is but one figure there and a very tiny figure. So, set you a task. Could you do that, please, first of all? So, pause at this point, work those figures through. We'll then check out to make sure we've got the right numbers. And then there'll be a very extensive exercise because here we want the taxable income for all years. And as we've seen, that's as early as 13-14 going through to 18-19. We're going to need a lot of columns here in relation to what we will record. But we'll come to that next. So if you pause therefore at this point, get those figures, and then we'll continue on together. So here we go therefore in terms of those losses and the assessment. Again, first tax year, 16-17, basis of assessment actual, basis period, start date 1st of July 16 through to the following 5th of April 17. Whether we're dealing just with profits or with losses or a combination of the two, as is the case here, the basis periods remain the same. Our presentation remains the same. What do we want to know? The tax year, the basis of assessment, the basis period here, and then we can do the calculation. So from 1st of July through to 5th of April is 9 months, and that 9 months is out of an opening accounting period, which was the full 12 months. It was a year end. So we take 9/12 of that 12,000 loss, giving us a £9,000 loss available for relief there in relation to the 16-17 tax year. On to our second tax year, 17-18, where we already determined, because we started with a full year end as our opening accounting period, CYB will be immediately available to us in that second year. That is its year ended June 17. That is the full loss of 12. We've already used 9,000 there in 16-17, so we take it away, and that leaves us with £3,000 worth of loss available. So 9,000 for 16-17, the remaining 3 of the £12,000 loss of the opening year available for the 17-18 tax year. On to 18-19, CYB of course applies. We should have that in there, current year basis, and that's the year ended June 18, a mere £2,500. So there is a summary of the losses available for relief. Now, we haven't been asked to identify all of the available options. We've been told very specifically to apply opening year's relief. So what you've got now, as I said earlier, is a lot of columns. You've got a very long writing out exercise, going through with columns from the 13-14 tax year, the earliest year to which we could take this loss of £9,000 back to. It's a 3-year carry back from 16-17, all the way through to the most recent year, 18-19. So you need to set those columns up on your working page. You need then to transfer from the question to your answer the figures provided. Up until the 15-16 tax year, we had our employment income and property income. Thereafter, the employment income ceases and the trading commences. But of course, in the first 2 tax years, there will be nil assessment before in 18-19 we are getting the £2,500 being assessed. So I'd like you please to include on those columns all of those income. So again, if you could set that up, pause at this particular point in time before we then look at the outcomes and deal with the application of these losses. Once you've got it set up down to total income for the tax years, it becomes a very easy exercise as to how we then apply those losses. So could you do that for me, please? So pause, as I say, at this particular point, and then come back and we'll look at what we've got. Okay, so here's our tax years, therefore, 13-14 through to 18-19. Pick up your employment income to begin with. It's just a copy-out exercise for each of the years. The other income, it was property income here. Again, a copy-out exercise. It was a standard £4,500 for each tax year across the board. Then our trading income figures, nil, of course, nil, because we have the 2 losses identified for those tax years of assessment before the very small profit there. That allows us to derive our total income, and then we're specifically told to apply opening year's relief. The first tax year, 16-17. How much loss did we have? We had £9,000. There it is. Where can we go back to? Back 3 years. From 16-17, go back 1, 2, 3 tax years to 13-14. We have total income of 17.3. We have a loss of 9,000 under the opening year's relief available. More than sufficient income to absorb that loss. Remember, we can't make partial claims. That reduces the income down to a net income figure of £8,300. Using our personal allowance for our 17-18 tax year across the board, that means that we've got more than sufficient personal allowance. Sadly, a bit of it is wasted there, but we reduce the taxable income down to 0. Moving on then to 14-15. Again, we have our total income, 15,500. This time from the 17-18 tax year, what lay behind the nil assessment? What was a net £3,000 worth of loss? Again, remember, no overlap losses. £3,000, again, more than sufficient income to absorb, bringing us down to a revised net income of 12,550. Take away your personal allowance, and there's just a small amount of taxable income for that year. Looking then at 15-16 year, bit of employment income, bit of property income, we're less than the personal allowance, nothing taxable. By 16-17, the employment has ceased. We're making no money in terms of profits. It's nil assessment. There's only the property income, obviously more than sufficiently covered by the personal allowance, nil taxable. Same situation in 17-18, a nil assessment, £4,500 property income, more than covered by the personal allowance. On to 18-19, well, at last we have a trading profit, but even when you add that to your property income, you're still nowhere near the figure of personal allowance, so yet again, it is a nil taxable income figure. Okay, have a review through therefore, make sure that you're happy with the way in which we firstly, when dealing with opening years, treat it as an opening year's exercise, using your normal bases of assessment for each relevant tax year, and establishing if there is a loss, how much loss, If there is a profit, what is the profit to be assessed? Assessments, of course, if we are talking about a net loss for the basis period for the tax year, that is a nil assessment. Then we separately consider what the loss relieving options are. That, as we've done it there, is the opening year's loss relief, notwithstanding, remember, that you'd still have, if you wished, to go with your normal loss relieving provisions, which would have been for 16-17, set off against the total income of the current tax year and or the preceding tax year. There would seem no point in doing that, given that those figures of income are covered anyway by the personal allowance. Same in relation to 17-18 there, the second tax year. You have income figures that are well below the figure of the personal allowance. Those claims would be redundant. There would be no point in making them. So here, yeah, you probably would indeed have made the opening year's loss relief claims, because although, yes, there is some wastage still of the personal allowance, there is still at least a reduction in earlier years' tax, and that will generate a repayment of tax in relation to those years. You'll get money back. Okay, have a review through, make sure you're happy with that, and again, just pause before we take you through to the final area. Well, very appropriately, the last thing that we do within this chapter is appropriately named as terminal loss relief. What this is, again, is the specialist relief available for a loss sustained in the closing years, very specifically defined, as we'll see in a moment's time, as a loss sustained within exactly the last 12 months of trading. But to begin with, again, just like it was with opening years, we work out what our assessments are within the closing years. So how do we do that when dealing in Chapter 6 with a cessation of trading? What do we do? Well, look at the example that we've got here. Example 6. First thing we did, I hope you remember step 1 here, was to determine what was the final tax year based on the cessation date. David had the following trading results before ceasing to trade on 31st of May 18. Therefore, what tax year does that fall in? 18-19. So there is your final tax year, 18-19. Step 1. Step 2. Go back to penultimate year. So if 18-19 is the final tax year, what's the one before that? The penultimate tax year. That must be 17-18. And assess using CYB. So to what date did we prepare accounts? We had a year ended 31st of July. So which 31st of July falls within your final tax year? Sorry, your penultimate tax year, 17-18. There you go. Year ended 31st of July 17. That ends in 17-18. Using your normal CYB basis of assessment, you'll have your 17-18 assessment figure, £6,000. Go back another year, of course it's still CYB, that's 16-17, and that will be your £28,000. So what I want you to do to begin with is just to work in normal assessments. What we'll be able to see is for the final tax year, 18-19, note it, leave it, go back to penultimate tax year, that is 17-18, that is the profit of £6,000. Once you've done that, then you know that all remaining profits, all remaining periods, fall into the final tax year. Well, here there is only one remaining final period. It's a loss-making period of 20,000. So that is the figure to be allocated to the 18-19 year. It's a loss. Therefore, the assessment is nil. Whereas for 17-18, we've got a £6,000 assessment. For 16-17, a £28,000 assessment. And what we'll do is to then set those assessments up on a working page, again looking at it on a columnar basis. So the final tax year was 18-19, we can go back as far as 16-17, so 3 tax years here for which we have information, 16-17, 17-18, 18-19. Our trading income assessments to include you need to do the proper working for this, but you know, 1617 CYB assessment, £28,000. 1718, there's our 1718 CYB assessment, £6,000. What was allocated to the final tax year, the loss-making period, therefore it is a nil assessment. Thank you very much, job done. What we've then got to do is to consider, having worked out the assessments, again looking at, are we talking about profits to be assessed, are we talking about a loss, then we have to consider what are the available reliefs. Well, very obviously, if you make that loss in the final tax year, there as we can see, it's £20,000, there's no carry forward. The trade ceases, there's nothing to carry forward to. So what would still be available? What would still be available, as it's been ever since the very first tax year, is your normal relief, set off against the total income of the current tax year and or the preceding tax year. Now, if those were the only sources of income, then there would be no point making such claims, because there's no income this year and there's only 6,000 in the previous year, all of which is covered by the personal allowance. So that would seem, under your normal rules, that there's nothing you can do. You're not going to get any benefit out of that loss sustained of £20,000 there in that final period of trading. So what can be done? Well, what can be done is to introduce now the specialist terminal loss relief that we introduced this session with. Right, what do? The terminal loss as computed is set against the trading profit for the tax year of cessation, if any. Note this is usually a nil assessment given the loss arising. Yeah, technically speaking, it is possible to sustain a loss within the last 12 months of trading and therefore have a terminal loss, and yet still there is a profit to be assessed in the final year. It is unusual, probably not going to see that in an exam question, but the rule says that first of all, having got on a separate computation the working of terminal loss, the set-off would be against trading income of the final tax year, though almost inevitably that will be a nil assessment. So effectively what it's then going to go against is, as we see here, and then against the trading profits of the previous 3 tax years. So again, a 3 tax year carry back, but this time with terminal loss rather than the opening year's loss. It is on a last in, first out basis. So what would that mean? We would be able to take our loss back against the trading income of firstly 1718, it's on a LIFO basis, and then against 1617. If, of course, there was enough loss, there isn't here, we could have gone back one more year as far as 1516, the carry back on a last in, first out basis against the trading income of the previous 3 tax years. 1718, 1617, 1516 in that order. Here, all of the loss will be utilised over the 1718 and 1617 tax years. So what we're going to be able to do is to work out the amount of terminal loss. Now you might be thinking, well, that's obvious, it's that £20,000, that's the final figure of loss made. No, we've got a very specific calculation of terminal loss that we need to follow. So let's go back to our note. As we've already stated, the terminal loss is the loss not of the final trading period, but is the loss of the final 12 months of trading. Very specifically, the final 12 months of trading. Computed in 2 parts, dividing up that last 12 months of trading between the 2 tax years that the last 12 months of trading is likely to fall within. They being the final tax year, and a part of the last 12 months of trading will no doubt go back into the penultimate tax year. And that last 12 months of trading, as we've said, is split between how much of the last 12 months falls into, firstly the final tax year, and then the balance of it into the penultimate tax year. So this calculation as follows. We want, firstly, the actual trade loss for the tax year of cessation, which means from the 6th of April through to the date of cessation, plus any overlap relief arising from opening years. Any overlap relief arising from opening years. That's why in the question, if I can just get rid of that for one moment, it said to show the loss available for relief under terminal loss relief, so very specific, assuming overlap profits on commencement were £5,000, and then to state how this loss would then be relieved. So first part of the last 12 months of trading that we deal with, the bit that falls into the final tax year, 6th of April to date of cessation. Add to it any overlap relief. Here, that's £5,000. An overlap relief serves not simply to reduce a profit assessment of the final tax year, it would also serve to increase or even create a loss here that would then be available for relief, and with this calculation, very specifically under the terminal loss relieving provisions. Having then dealt with that part of the last 12 months of trading that falls in the final tax year, we then look at how much of the last 12 months of trading falls in the penultimate tax year. So the actual trade loss for the period 12 months before cessation until the end of the penultimate tax year. We've got the bit from the start of the final year, the 6th of April through to date of cessation. We want the bit from 12 months prior to cessation through to that 6th of April date there. So the bit that falls into the final tax year. If as you do this calculation, the result in either 1 or 2 should be a profit, it probably won't be. But if it did form such a profit, that in this computation of terminal loss would be treated as nil. We'll talk about that when we do the example in a moment's time. Right. Let us, therefore, tackle this example now. Now, we've already done the first part. We have, using our bases of assessment that apply in closing years, establish what your trading income assessments are. What we've got here, let's get rid of all of this for you so we can see it more clearly, is that we have a nil assessment in 1819, the year of cessation. We have then £6,000 and £28,000 respectively. Right. We know that under terminal loss provision, our terminal loss relief will go directly against trading income. Unlike the specialist opening years relief, where we could go against total income, no, with terminal loss, it goes just against trading income. Not that we need any logic to it, because it's a rule, and rules are created by people, and people can design whatever rules they choose to make. But here the idea would be, because you've ceased trading, it, as we started this discussion with, means that there's no carry forward. There are no future trading profits of the same trade. So if you can't go forward, what this relief is allowing you to do is to go back. And we can go back against the trading income of the previous 3 years. So that's where any terminal loss relief will be applied. But what we've got to be able to do is to compute that terminal loss. So we would now need our working to compute the terminal loss. Now remember what we said, we break it up into 2 parts. Firstly, that part of the last 12 months of trading that falls into the final tax year, which was 2018-19. And that itself is made up of 2 constituent components. First of all, let's have a look at what we've got here. Again, let's clear the next of all of that. What we know here is that we ceased trading on the 31st of May 18, and the final accounting period was the 10 months to May 18, in which we made a loss of 20,000. So 10 months to 31st of May 18, 20,000. First part of your terminal loss here in the final tax year, the loss from the start of the final tax year, that will be the 6th of April 18, through to your date of cessation. Again, remind you, what was the date of cessation? there it is, 31st of May 18. So 6th of April 18 to 31st of May 18. How many months is that? April, May. It's 2 months. That is 2 months out of what we've been told is a 10-month period in which we made a loss of, how much was it? There we go, it was £20,000. So 2/10 of 20,000, nice easy calculation there on a 20,000 round figure, 2/10 of that is going to be what? £4,000 worth of loss. £4,000. The second component of the terminal loss computation, still within that final tax year, we allocate to it any overlap relief, our overlap profits from opening years, which now is overlap relief. What were the overlap profits? They were £5,000. Again, a figure that you pick straight from the question. Overlap relief here, overlap relief, I think, singular, that is £5,000. So within the final tax year, the last 12 months of trading falling into the final tax year, we have got £9,000 worth of loss. So having dealt with the final tax year, we move back to the penultimate tax year. And we want now the amount of the loss from a date 12 months prior to date of cessation through to the following 5th of April. We want to know how many months is that and what loss, if any, arose within it. So we ceased trading at the 31st of May. So we therefore, if we go back 12 months from that, we would be talking about the 1st of June 18 through to the 5th of April, sorry, the 1st of June 17, I should say. Oops, watch your date. It's very easy to make mistakes. 1st of June 17 through to the 5th of April 18 there. So the last 12 months of trading from the 1st of June 17 to the 31st of May 18 there. That will be your last 12 months of trading. The last 2 months of it, from 6th of April 18 to 31st of May 18, allocated to the final tax year. The remaining 10 months from 1st of June 17 through to the 5th of April 18 will now be allocated to the penultimate tax year. So what goes in there? Well, to begin with, of course, if we work back in time, we have allocated to the final tax year 2 months of the final 10-month loss-making period of £20,000. So very clearly, therefore, we now need the remaining 8 months of that 10-month period in which there was the loss of £20,000, and that, therefore, will be a loss of £16,000, a loss of £16,000. But that does not take us back the entire period. What we've done so far is to look at the last 10 months of trading. 2 of those months fell into the final tax year. 8 of those months fell into the penultimate tax year. We've got to go all the way back to the 1st of June 17. Now, what we had been doing, look back to the information in the question, is to prepare accounts to a year ended 31st of July. So the year ended 31st of July 17, some of that falls into this penultimate tax year, because we've got to go back as far as the 1st of June 17. June 17, July 17, therefore 2 months of that 12-month period of it was a profit figure. What was the profit figure? Sorry, I keep churning you back from one screen to another there. That was £6,000. Therefore, into this computation, 2/12 of a £6,000 profit, that, well, 2/12 is 1/6 of 6,000, is £1,000. Therefore, that will serve to reduce that £16,000 of loss down to £15,000. That can then be added to the £9,000 worth of loss within the final tax year to give you an overall terminal loss figure of £24,000. There is your available terminal loss relief. Now again, you'll need to look very carefully and go back over this to determine how it was that we computed that figure. We couldn't just take what was the final period. No. What we've had to do is very specifically break down the last 12 months of trading, how much of it fell into the final tax year, how much of it fell into the penultimate tax year, and therefore work the loss that way. That is 24,000. Now you know the figure, the final piece of the jigsaw, the terminal loss relief to apply there. We go back on a last in, first out basis. We've got £24,000 of loss. The first thing to go is the trading income of the previous year. That was £6,000. So we've used 6,000 out of the 24,000. That therefore would leave us with some £18,000 of loss. 18,000 to go back against the trading income of 1617. There is sufficient income, as we can see there, to absorb that, and that will still leave you with £10,000 worth of trading income assessment. Okay, I need you to go through, check back with the notes, with that example, make sure you're comfortable with that before we then add in one final little statement just to complete this exercise. So again, briefly just pause while you go back and check out, before I say anything else, that you're comfortable with what we have done so far. Okay, the final little point here, just going back to the very final statement under our note on terminal loss relief. It says if the result either in point 1 or point 2 here was the specific calculation of your terminal loss, how much of the last 12 months of trading fell into the final tax year, how much into the penultimate tax year. That's your 1 and 2 here, as stated there. If either of those figures should turn out to be a profit figure, then it would be treated as 0 for purposes of the terminal loss computation. So, what have we got here? Now, as you'd expect, any bit falling in the final tax year is likely to bring you to a loss figure overall, which it is. We've got 9,000. There was a loss figure there of £4,000, so there's no profit there. And then for 1718, well, again, we took the remaining 8 months of the loss, and that gave you £16,000 there. And we just had 2/12 of 6,000, £1,000 of profit. Therefore, the net result was a loss. It got added to the 9,000 to give you 24,000. Fine. It isn't likely, I think, at our level that we're going to meet a problem here with this, but the point being made. If that's 6,000 there, instead of being 6,000, would have to be a much, much bigger figure, but to give you a nice, easy number, was, say, a profit of 120,000. 120. Now, if that was 120,000 profit, then 2/12 of 120,000 wouldn't give you £1,000 as we got it there. Very obviously, it would give you £20,000. Now, if you had £20,000 profit, 16,000 loss, then what now would be the figure there? Well, without this note, you might have put into it a £4,000 net profit. The answer tells you, the notes tell you, you don't do that. That would be nil going in. What it meant was, as soon as you determined the part of the loss of the final tax year, that there was the 9,000, that loss was always going to be available for terminal loss relief. Whatever happened in this second part here didn't make any difference. You were always going to have a minimum of 9,000. Now, as I've suggested to you, I suspect that at this level, we're not going to have that problem, that here, the amount of profit going in to that last 12 months of trading in the penultimate tax year is going to be bigger than the amount of loss. It should be a loss figure, you add it in. But outside chance, if it turned out to be a profit, you just write in nil for purposes of the terminal loss computation. Okay, those are our loss reliefs. In our next chapter together, Having dealt so far with chapters 4, 5, 6 and 7, focused on the unincorporated trade, we've basically been talking about one person, the sole trader. But as we mentioned at the outset, what we know is that unincorporated trades may also be in the form of a partnership. What then happens? Well, we discover the answer to those questions in chapter 8, where we'll discover that there is no partnership to be taxed, but each partner is to be taxed on their share of the tax-adjusted trading profit made by the partnership. Once we've got their share of the profit, we will use our normal bases of assessment for each individual partner. And should there be a loss, each partner will be free to choose their own loss relief in relation to the loss sustained by them, their share of the partnership loss. So we will assess partners, not the partnership. All that and more in chapter